Has investing in real estate in California reached the end of its days? Has it been over for a while? And what do Graham Stephan, Grant Cardone, Elon Musk, Joe Rogan, and Jenna Stacy Conkey all have in common? We all left California.
And there's more to it than just leaving the state. By the end of this video, you'll understand why we don't invest in California, why you might want to think twice before investing in California, and what better options are out there even if you live in California. Yes, we're talking about remote investing.
We have been investing in real estate for 20 years, and most of that time we spent living in California, but we learned quickly that there were better and easier markets to break into, especially if you're just getting started.
When you're getting started investing in real estate, it can feel like you're a deer in the headlights. There's so much you need to know, and you're not really sure where to start. In the Remote Multifamily Investing Academy, there's a reason that the very first thing our students learn is how to select a market. It's because without knowing where to invest, you'll find yourself bouncing all over the place, gaining zero traction. That is no bueno. So why do we say not to invest in California? We'll get to that. There's actually several places in the US that are just not good for investing in real estate.
But let's start by talking about what does make a good market for investing in real estate if you're trying to get started in building passive cash flow. Well, first things first, let's talk about the 1% rule. You may have heard of it before. Very simply, it's this. The market rents on a monthly basis are at least 1% of what properties sell for.
Let me give you two conflicting examples. So we lived in San Diego, California for a long time. When we moved in 2021, we could realistically purchase a 3-bedroom, 2-bath home, about 1,800 square feet, in a decent, not great, just decent neighborhood for about $700,000. In order to meet the 1% rule, we would have had to rent that property out for $7,000 a month, or 1% of the purchase price. Unfortunately, market rents for that same house and that same neighborhood were closer to $3,000 at the time. We are very far off from meeting the 1% rule.
Next, let's contrast that with a property in a different market. Let's say the Midwest market. Let's say we could buy a single family home for around $150,000. If the market rent were $1,500 a month, that would meet the 1% rule. Now, let's take it one step further. Let's say we could buy a duplex for that same amount of $150,000. And let's say each unit rented for $850 a month. Our total monthly rental income would be $1,700, definitely above the 1% rule. And this is why we love helping people get started with small multifamily and teach them how to do it remotely.
Because sometimes you don't live in an area where the numbers work out that way. In fact, most of you watching this video probably don't. That shouldn't mean you don't get to invest and create passive cash flow for your future. You just want to invest where it makes sense in order to get passive income, and where you don't have to sell your firstborn plus a limb or two in order to get the down payment.
By the way, if we haven't said it already, we love California. We still visit there. And what are your favorite places to go to visit in California? The zoo, Hollywood, SeaWorld? Drop your favorite below.
Now, the 1% rule is not the only reason we say not to invest in California. We'll give you a few more reasons shortly, but let's not leave you hanging on market selection. Here are two more things that we look for when choosing a market. It's not only the 1% rule: population growth and job growth.
You want to see that the markets you're considering have populations and a job market that is at a minimum steady and ideally growing. And when you're holding units and you have one for rent, the last thing you want is to be dealing with a market environment where you have a supply and demand issue. Less demand because of a declining population and a declining job market. The markets that are most compelling are the ones that are actively trying to attract employers, because more jobs equates to more people moving to the area, so they frequently work hand in hand. So 1% rule, population growth, job growth.
Now, why do we say not to invest in California? It for sure doesn't meet the 1% rule, and that's enough reason, but here are a couple more. There's a huge barrier of entry. What does that even mean? It means, how hard is it to get started buying property there? When you're dealing with markets where the entry-level purchase price is less than $200,000, getting into a deal is going to require a lot less capital than a market where the entry-level prices are $700,000.
There's a down payment needed, closing costs, financing costs, sometimes impounds, depending on the lender. So getting started in a lower price market, assuming it meets all three of the criteria we already discussed, is so much easier to get into. And remember, you don't have to be the one with the capital.
That's right. 95% of the deals done in the Academy are joint ventures, meaning more than one person is involved, and sometimes there's someone putting in the majority of the funds while another person is doing more of the work. Every deal is different, but not having a ton of capital never needs to be the thing that stops you from doing real estate. When we were new, that was exactly how we started because we didn't have a lot of capital. So we did joint ventures and created a win-win with another investor so that we could all get started together. Okay, so why else not to invest in California?
Look, California's landlord laws are very friendly towards tenants and very unfriendly towards landlords. Things like rent control, huge red flag, and difficult eviction processes. It's the same reason you'll hear people say not to invest in New York. It's actually all the same reasons. No 1% rule, huge barrier of entry, and terrible laws for landlords. And we truly want to help you get started with building your cash flow portfolio. And look, sometimes you need to go outside your home market to make that happen.
99% of the deals done in our academy are done remotely. It's actually pretty rare for any of our students to do deals where they physically live. They're doing it, and you can too.
Thanks for watching. If you liked this video, give it a thumbs up. Watch our next video on the top gurus' real estate advice and what they're not telling you, exposing some of the secrets that Graham, Uncle G, and Bigger Pockets are holding out on you. What? Watch it. See you next week.